Hi everyone, in this video I'm going to be walking you through our financial statement analysis project of key performance indicators or KPIs. Here you're going to be looking at our summary analysis tab where we will pull in the various key performance indicators from these additional subsidiary tabs here. And in this project we're going to be analyzing three different car companies, US based automobile companies, General Motors, Ford, and Tesla. And overall, what we're going to be doing is calculating a number of different ratios. And as I wanted to use this term key performance indicator in this project specifically because that is a term that you will often hear out in practice when it comes to specific ratios or financial analysis ratios that a business would look at to analyze its performance. And kind of as the name indicates, these ratios are specifically an indicator of the performance of the company, and these are some of the key indicators that management as well as outside parties might want to look at when they are assessing different types of companies. We will come back to this tab and complete this closer to the completion of our project here. We're going to start by completing the analysis of each individual company first, and then we'll pull that information into our summary analysis tab here. And after pulling in the actual key performance indicator results for each company, we're going to assign a specific color to that key performance indicator for the given company. And that way it'll give us kind of a quick and easy ability to analyze each of these KPIs and see whether the results for each individual company are favorable compared to a benchmark. And when I say benchmark, I mean that same key performance indicator for the whole industry. So, for example, what is the profit margin ratio for GM, for General Motors, compared to the overall profit margin for the entire comparable automotive industry? So that's what we mean when we use the term benchmark, something to compare the company against in order to determine whether that result of the KPI is favorable. That we will mark that in green, whether the result is approaching unfavorability or slightly unfavorable compared to the benchmark. So, yellow is kind of our warning sign, and then red would be specifically unfavorable compared to the benchmark. We'll come back to some of these notes once we fill out the tab later. I do have the benchmarks listed over here for each specific key performance indicator, so we will keep that in mind when we are completing our color analysis, like I mentioned, more towards the finalization of the project. So here's a spot to put your name in, just something there. And once you have that done, let's go ahead and I guess I'll type my name in here. So once you have that put in, go ahead and click over to our General Motors tab to begin. So you will have noticed within Canvas a link to access specific excerpts from these companies' annual reports. Specifically, we're going to be pulling out the income statement and the balance sheet, and we're going to use that data for each company to complete the calculation of these key performance indicators. And we also have, we can look here on the stock prices tab. These are stock prices pulled as of April 2nd, 2026. I just included screenshots here. I also typed in the information below so we could link the results into our analysis calculations here. Stock prices change all the time. So if you were actually doing this in a professional capacity, you would be wanting to get, current, up-to-date information most likely. But for our purposes of doing this as a class, I have just pulled this out for you. And I took these screenshots from Yahoo Finance. So there's different websites you can use to pull down current stock prices, etc. But I just used Yahoo Finance and pasted these in here. So we had easy access, and you all wouldn't have to do as much hunting around the internet to get these figures. Okay, line that up just a little better there. That looks better. Okay, so let's get back to General Motors. So as I mentioned, we have pulled out and available in Canvas PDFs, like I mentioned, excerpts or several pages pulled from each company's annual report that they file annually, obviously. And those are very long reports, over 100 pages with lots of valuable and interesting information. But I just pulled out the income statement and balance sheet because I really wanted to target our focus on that. That's what we're going to use to complete our key performance metrics. And let me click over and we'll just take a quick look at the PDFs and see what they look like. I'll walk you through briefly of what those look like, how we're going to use them. And then I'm going to click back over to our Excel view, and I will have these PDFs of the company's financial performance and their financial statements off to the side, just like I would expect you all to have as we're working through this process. And you can pull the figures out yourself that way. So let's click over to the financial statements now and take a quick. So as I mentioned, you can see here the General Motors income statement, consolidated income statements. In class and generally in academic terminology in most of your accounting classes, we just use the terminology income statement, balance sheet. You will see other names used in practice as far as the titles of these types of reports. For example, this report here, you can see it's a consolidated income statement, essentially meaning that there are multiple entities, business entities, sort of rolled up into one income statement. So there are some technicalities that can lead to different naming conventions. You might have heard of the term profit and loss, or P&L. That's a terminology used in certain accounting softwares like QuickBooks to represent the income statement, essentially. But for all intents and purposes, to keep it simple, let's just think of this just income statement like we've talked about in class. You've got revenues, expenses, calculations of net income. One thing to note, you might see these numbers and I don't know, think they look small, something to that effect. I'll zoom in a little bit here. But keep in mind that this is in millions. So when we talk about 171,606 here for automotive net sales and revenue, that is really reflecting $171 billion in revenues, essentially. Within, come down here, net income here at the end of December 31st, 2024, this would be, $5.9 billion in net income. Okay, so this is the income statement. And as I mentioned, you see different names in practice. Zoom out here. And so consolidated income statement for General Motors, consolidated balance sheets, same thing in millions. So just keep that in mind. But hopefully this looks familiar to you from all the work that we've been doing in class this semester. So you've got, you've got your balance sheet here. So current assets, non-current assets, totals, and then the same for liabilities. And then equity down here. You can see total assets equal total liabilities plus equity, 279,761, 279,761. So, the key fundamentals that we're learning in our class this semester are key, and they're actually played out in the real world. Assets equal liabilities plus equity is not just a classroom concept. It's a fundamental underpinning of the entire process of accounting, and that applies to companies big and small. So yes, balance sheet here. This is for General Motors. And then we can just click through. I've aggregated all three of the companies into one PDF file just for your benefit and my benefit, less files to open, make it a little easier. So here you can see the Ford Motor Company. One thing to keep in mind here that can sometimes be a little bit of an issue when you're inputting information is that the years in the General Motors statement increase this way. So 2022, 2023, 2024, increasing to the left. But in the Ford Motor Company, 2022, they increase to the right. So just be careful with that. So if you're inputting the leftmost column when you're doing GM, in order to get the amounts to be highlighted there for our metrics, just be careful you're not comparing that to 2022, because they would, that's an easy mistake to make if you do this quickly. It's a little bit of an issue there, just from a input and quick glance perspective. So be careful with that. So 2024 is this here for Ford, but same thing. The income statement is a calculation of net income for each of the companies. We've got the balance sheets here: assets, liabilities, equity. You can see it balances, and that's great. And then for Tesla, we have the statements here. For Tesla, then, the most recent year, 2024, at least in our analysis, is on the left side again. So again, it's on the right side here for Ford, increasing to the right, but for the other two companies, it increases to the left. So just things like that. Be careful when you're, it's kind of an issue for data entry, I suppose, in our purposes here, to make sure that you don't pull from the wrong column. But same kind of thing. Revenues, we got gross profit calculation, net income, and assets, liabilities, equity. So the whole goal of accounting and presenting our information for a company in accordance with U.S. generally accepted accounting principles, or U.S. GAAP, is that these financial statements are all operating under the same rules, essentially. So we can do these kind of comparisons. And, if every company was using different rules and accounting for things in different ways, then we wouldn't be able to make these comparisons of key performance indicators as easily. So anyway, I just wanted to make a note of that, because that's kind of a huge fundamental underpinning of the whole entire idea of accounting under U.S. GAAP, is that all companies basically do their accounting under the same set of rules, so that we can have comparability and make comparisons effectively between companies, which is what we're going to do. So with that said, it's a good segue back to our Excel analysis summary, but I just wanted to walk you through this quickly. So my expectation, I suppose, as we're doing this project, you'll have this open off to the side, and then you can have the Excel spreadsheet as well. And we're going to pull in information from the PDF into our Excel to complete our analysis. You won't be able to see this PDF while I am working through the Excel spreadsheet, because I can only have one screen on screen being recorded for this video at a time. But that's the process that I'll have this off screen on my second monitor, but we will just be focusing in on the Excel input spreadsheet. So without further ado, let's click back over to the Excel and get started inputting our data. Okay, we're now back over in the Excel spreadsheet here. And as I mentioned, I've got the PDFs for the income statement and balance sheet on my second monitor, so I can look at that and do inputs. And let's get started. Okay, so we're going to start with General Motors as our first company to analyze. So again, we're on the General Motors tab for the KPI calculations. We've got, how many do we have? 10, I believe. I picked out 10 specific key performance indicators that are applicable to the automotive industry. We've got profit margin ratio, operating margin ratio, return on assets, return on equity, current ratio, debt to equity, interest coverage, inventory turnover, AR turnover, and price to earnings ratio. So we're going to calculate all these for each of the three companies, and then both compare them to the benchmarks for the overall auto industry, and then also compare them to each other. So that's again what kind of US GAAP basically allows us to do as individuals, analyzing the company's financial performance. Okay, and we've got our benchmarks. You can kind of see those off. So when it says benchmark, again, that means the kind of the standard, if you will, for the automotive industry, or just kind of the average. And so we want to see how does GM fare to the overall auto industry. That's what the benchmarks are for. Okay, so we're going to start with profit margin ratio, and we're going to be looking at two specific inputs for basically each of the ratios. And profit margin is a comparison of net income versus net sales and revenues. So another word, gross profit margin is terminology you might have heard for this one. So net income off of the income statement for GM here is 5,963 million, or 5.9 billion, like I mentioned. And that is net income after accounting for all expenses and revenues minus expenses. Net sales and revenue is going to be 187,442, so 187 billion. And this figure here represents total sales before accounting for all of the expenses, all of the cost of goods sold, and the operating expenses, etc. The term net sales and revenue refers to the fact that we do account for things like discounts. If you remember back to that chapter where we were calculating net sales versus gross sales, is considering the calculations or the reductions for things like sales returns and allowances and discounts, so on and so forth. Okay, so we're going to do a calculation here. We're going to put equals, and we're going to take our net income divided by net sales and revenue, and that gives us a 3.18% profit margin ratio. So you can see, compared to the benchmark, a little bit on the lower side. I mean, yeah, definitely on trending towards the lower side of the benchmark. So this is kind of an assessment of how much of our net sales and revenue are we keeping when compared to our overall net sales. How much of our net sales and revenue do we get to keep after accounting for expenses? And I misspoke earlier too. I said gross profit margin. This one more so comparing not so much the gross profit margin, but the net income compared to our net sales and revenue. So for every dollar of sales that we earn, or GM earns, the company is able to keep 3.18% of each dollar as net income after accounting for all the expenses of running the business. Okay, so then we've got our operating margin ratio. This is one that the automotive industry uses. Our operating income here, we've got 12,784. And this is after accounting for the cost of sales. So we are basically taking our total net sales and revenue minus costs and expenses here. And this is before interest expense, interest income. So kind of everything before the other category, quote unquote, other expenses and revenues, so on and so forth. So operating income of 12.7 billion. And then again, our net sales and revenue, we already input above. So we can just link back to that tab. And then we can go through and do a ratio there. So 6.82. Okay. Return on assets is going to take our net income. So again, we can link up above 5,963. And then we need to go to not our income statement now, but our balance sheet for General Motors. And total assets is 2,79761. And then again, we can do our division, 2.13%. A little bit on the low end there. Yeah, lowish in regard to operating ratio as well. But let's keep moving on. We'll compare all the metrics together at the end. Return on equity. Again, we can link up to net income. But here we're going to need to calculate the average stockholders' equity for the year ended 12/31/2024. So the way we're going to do this in our calculation here is just kind of a simple average, taking the ending balance of stockholders' equity at the end of last year and then the current year, or the prior year, current year, add those together, divide by 2 to get a simple average. So let's start by putting in our stockholders' equity amount here at the end of 12/31/2024. And we look on our balance sheet here to the total stockholders' equity line, and we get 63072. And then let's look at 12 for the prior year, for 12/31/2023, and we get 64286. Then, as I mentioned, we can just add these together with a formula and then just divide those by 2. So it ends up giving us average stockholders' equity over the last year, essentially. So then we will link to that number and do our formula calculation, and we get 9.4. So a little bit under the benchmark there. Interesting. Okay, let's keep going down. Now we're on to the balance. We were using our balance sheet for GM, and we're going to continue on with using that here for the current ratio. And current assets comes out to 108,545. And then current liabilities of 96265. And again, dividing current assets by current liabilities, 1.13. Again, a little under the benchmark. Okay, let's keep moving down. Debt to equity ratio here. We're going to take total liabilities. So here's current, right? Current ratio only considers the current assets and liabilities. Now for debt to equity, we're going to input total liabilities. And so we end up with total liabilities of 214,171. And total stockholders equity, we already used that above, so we could just link here. So we're using the stockholders equity at the end of the 2024. I like to link wherever possible so that if you do have to make a change or fix anything, it just carries through, makes it a little easier. Just typing things in everywhere and not using formulas is known as hard keying numbers in, and generally it's a practice you want to avoid because it doesn't allow for the linkages that are a key component of using Excel, where if you make a change to a figure, you correct something, that correction carries through all your subsidiary calculations, etc. If you hard key everything and you make a change to a previous ratio, you would need to find every instance of that number being used and fix it manually every time. So the least amount of manual inputs we can do, the better. Let Excel do the calculating work. Okay, interest coverage ratio. So this is kind of a new one. Earnings before income taxes, earnings before interest and tax. So we're gonna take our total earning or income before income taxes here. So I'm going to go back to our income statement and let's find our income. So income, so you'll see the line says income or loss before income taxes, 8519. And let's see our interest expense. And so this figure, I'll just say this is already before income taxes. So we backed out, this is not, so earnings before income tax, interest and tax. So this number is before tax. Now we're going to put our interest expense in here. Where are we at? 846, I believe is what we're using. Yeah. And that line says automotive interest expense. Okay. And then we're going to just take that 8519 minus the 846. Oh, sorry, no, I did that backwards. Plus the 846, because remember we are backing out the interest expense. This number of income before income taxes has already reduced income by the interest expense, so we need to add that number back in. In other words, if you were to look at this kind of progressively as a formula, it would be this number, and then if you were to get to this number, you would take earnings before interest and taxes minus interest expense. And then you would subtract the income taxes to get net income. So it's kind of a maybe a little weird to think of it that way when you're adding expenses back to increase the number, but we're just basically adjusting that to reduce those expenses, which means the income that we're calculating our earnings will increase. Less expenses, higher earnings. And the reason we're using this figure is just because it's more of an indication of the income from operations to cover these components, taxes and interest, etc. Okay, so that's what we have there. We can just link into the formula. And interest expense, we can also link that. And then we can do our division, and we get see 1107. So we're looking really high above the benchmark there. So that indicates that we have a lot of operating income available to us to pay for our interest expenses and our taxes, which are kind of tied into our income. The higher or less income you have, taxes just kind of moves with that. So that gives us some comfort if we're an outsider or a manager looking at the business to feel comfortable that we'll be able to pay the interest on our long-term debt. Okay, let's keep going. Inventory ratio. So cost of goods sold, average inventory. So yes, let's look at cost of goods sold. We're going to pull in this 151,065 number, which is listed specifically as automotive and other cost of sales in the income statement. And then again, we need to go to our balance sheet and do a calculation of average inventory here. So 12/31/2024 plus 12/31/2023 divide by 2, just like we did for shareholders' equity above. So let's look for inventories. We got 14,564 for the 2024 value, and then we've got 16,461. Add both years, divide by 2 to get an average. Link that there. Do our calculation, our division, and we get 9.74. So in essence, what we're saying is our total inventory that we have at hand at any given point in time, on average, has turned over or completely sold and then been replenished and sold down to zero again about 9.74 times during the year. So that's pretty good, above the lower end of the benchmark. Okay, and then let's look at our AR, accounts receivable turnover. So first thing we can do, we need net sales and revenues. Just link that in. And then we need to do, again, a calculation for average AR. So we're going to go in and look at the balance sheet, and we see GM financial receivables, net of allowance. So that's the figure there that we want to pull in, and that number for 2024 was 12,827, and it was 12,378 for 2023. So then we'll add both of those. We'll divide. So 12,603, link to our cell there, and do our division. 14.87, looking very solidly in the middle of the benchmark. Okay, price to earnings PE ratio. So here's where the stock price comes into play. So we're going to say equals, and then link, go over to our tab here. We're going to use the GM stock price at April 2nd that I have snipped there, screenshotted, and it's 72.32. And then we're going to look at earnings per share. So this is on the income statement, kind of down at the bottom underneath the net income line item. And we're going to look for the specific line of earnings per share. There's a few different calculations of it, but we're going to use the diluted earnings per common share number. There's a number of different types of earnings per share that you can use. This is the one that encompasses the most comprehensive view of earnings per share. We won't get into the technical details here in this class necessarily, but that's the number that we're going to use for our purposes in calculations. Okay, so do our division again, and we've got all of our metrics there. So now I'm going to pop back over to our summary analysis tab, and let's go ahead and populate excuse me, our metrics here. So 3.18 and number 2, 6.82, return on assets, 2.13, return on equity, current ratio, debt to equity, interest coverage, inventory turnover, AR turnover, and finally price to earnings ratio. Okie dokie. So now we've got all those listed in, and while we're here, maybe let's just fill out our color analysis. And so when we look at the specific metrics and then we compare those to the benchmarks, we've got 3.18. So I'm going to put that one in yellow. It's very, so yellow again, approaching unfavorability or slightly unfavorable. So not slightly unfavorable, but is definitely approaching the lower end of the benchmark. So we're going to do a yellow on that. Green here, we're within the 5 to 10% with 6.82 on operating margin, 2.13, again very close to the lower end of our benchmarks. Range, return on equity, kind of a same story. Oh, actually we're a little bit under on that one, so we're going to just use yellow there, just slightly under the 10%, 9.36. I'm going to go with yellow. Current ratio, yellow as well, close to the bottom of the range essentially. Some of this is a judgment, call. Maybe this, if you thought that 9.36 was red, maybe that's true, but we're just kind of, this is just sort of an example too of how you would approach these kind of analyses, and then preparing something like this to hand to a CEO or a board of directors or some sort of party that's interested in your ongoing analysis is a really real world type of process and analysis report that you might create in these types of situations. So again, a bit of a judgment call. I'm just putting it in how I see it. There's a little bit of a more of an art than a science thing with this kind of analysis, but this is how it goes. So 3.4 solidly within the benchmark. We're going to go green. 11.7. So this one's way over the benchmark there, very much covering our interest costs. Inventory turnover, I'd say solidly within the range. And 14.87, again, solidly in the range for AR turnover. The price to earnings ratio is kind of interesting. This one doesn't quite exactly adhere to our favorable, unfavorable analysis. And really what this most really indicates from a market perspective, and I'm just going to put this in, is we're going to say we're within the benchmark range. And so that would kind of indicate to us normal growth expectations. I wanted to just note that because it's not quite as close. If you have an interest coverage ratio that's not sufficient to cover, you not have enough revenue to cover your enough earnings to cover your interest, that is not good. And so that's where we unfavorable makes more sense. But with price to earnings ratio, really we're taking into account market expectations with that stock price, etc. And so this is more kind of about what is the market, or investors as a whole kind of expecting for the company's future growth opportunities. So a little bit different there, but I just wanted to highlight that as not necessarily using our color code for that specific KPI. And we'll do the same for the other two companies with those. All right, so that was General Motors, and we've got everything in there. And then we'll jump over to... Okay, so now we're on to the Ford KPI spreadsheet, and we're going to do basically the same process of input off of Ford's financial statements like we did for GM. Continue the same process overall and work towards our full comparison. Okay, so let's look at Ford here. And again, remember that the 2022, 23, 24 goes left to right for Ford as opposed to the other two going right to left. So be cautious when you do an input there. 58.94 net sales and revenues. We've got 184.992. We can do our calculation there. I'm going to go a little bit quicker on this one. I kind of talked at length while I was completing the GM tab, so bear with me as we kind of just move through this, and hopefully if you have any questions about where numbers coming from, have that PDF, stop the video, make sure you're following along. But anyway, we've got operating income 219, net sales and revenue we can just link above 182. Link at our net income. Now we're going to go to our balance sheet to look at our assets. So our total assets are 285,196. Return on equity. Again, linking as much as possible. Okay, we need to do our average shareholders equity here. So we'll go to our balance sheet. And let's see, 4835. And in this number, we're using the total equity attributable to Ford Motor Company, not including the equity attributable to non-controlling interest. So some of the figures I'm using, they're kind of deeper discussions and further technical and conversations outside of the scope of this class to understand what the difference between the different types of equity, like I said, the earnings per share. So if you want to learn more about those things, do some research on your own. But that's a little bit more of an advanced topic. So just kind of take it from me as we use certain metrics and line items. Why are we using one line of equity not versus the next equity attributed to non-controlling interest, so on and so forth. Okay, so last year's was 42,773. With that said, one thing this is just a general comment, be really careful about when you're doing these kind of analyses. If you're using one specific type of line or one certain line item like I just mentioned, make sure when you go back to the prior year to compare that number that you're using the same line item. You're not using one equity amount in 24 and then the different equity amount 2023, right? So make it comparable for sure. Okay, 13.5. Let's go to the current ratio here. Still on the balance sheet. And we've got 124,474. Current liabilities is 10. Oh, see there, I started to almost do it. I guess it's the same numbers, but 106,859. I almost put in the 2023 to 2024 because it just kind of messes with my mind when it's going not going left to right the same way as the other two. Debt to equity, total liabilities is 243.38, and total stockholders equity, again, we can just link that here, 5.36. Okay. Excuse me. Interest coverage ratio. So again, we're going to do this little calculation here. So we need to go back to the income statement. Income before income taxes is 7,233. Interest expense is 1,115. We're going to add those together because we're adding back that interest expense. We want the number before we reduce for interest expense. So we'll link there. And we can link the interest expense. 7.49. Okay. Inventory turnover ratio. Let's look at our cost of sales, 158,434. Average inventory. Oh, we need to calculate that. So inventory here, back to the balance sheet. Inventories. Here we go. 14,951. And 12/31/2023 for inventory is 15,651. Add, divide by 2. Whoop. Oh, no, divide by 2. Typo there, sorry. Oh, why is that not working? Oh, my number lock on my keyboard must have got weird there. There we go. Sometimes if you ever have that issue where you're trying to put a number in off your keyboard, especially if you use a 10 key, that's like where your numbers are kind of like a square, like on a calculator. I have that on my keyboard. Maybe you do. If you ever have that issue where it's not putting the numbers in, there's a button called number lock that might have gotten pressed or unpressed. Okay, finally, accounts receivable. Let's take a look here. 51. Is that the number? No, AR. Where are we at? Oh, trade and other receivables. Yeah, we want trade receivables. So 14,273, 15,601. Same calculation there. Net sales and revenue. Let's link that above. And average AR. There we go. And AR turnover, 12.2. Still within the benchmark, but getting close to the bottom. Okay, price to earnings ratio. So again, we're going to go to our stock prices. Let's go to the Ford one here. Link that. Earnings per share. Let's go to our income statement. Excuse me. And again, we're going to use the diluted income earnings per share number, 1.46. So keep that comparable, between companies, like I just mentioned. Between years, use the same line items. Between companies, use the same version of the metric. Definitely don't want to use different specific. You're using the basic earning per share for one company versus diluted earning per share. You want comparability. That's important. Okay, so we've got all those listed. I'm going to show you a little trick here that I think we could utilize to make this work relatively quickly. So one thing that we could do is we could copy each of these formulas like this. And in this instance, I just kind of want to practice, show you a little Excel trick. And there's quicker ways to do this, but I'm going to sort of do it a little slower. So you might, after seeing me do this, go, well, that wasn't faster. But this is, I think, valuable from an Excel perspective. A little trick here. So if these spreadsheets are exactly the same, and you kind of tell they're the same, it ends at row 67. I designed them to be the same. Basically what I'm saying is the calculations are in the same cells. So here it is, C16 in Ford for ROA is the same C16 for General Motors. So if you have spreadsheets like this where you're pulling data together and it's the exact same type of spreadsheet, one thing we could do, you see, is just highlight this formula, Control C to copy that, then hit Enter to move out of the formula bar there, and then paste this all in, with the result being, and you could also just double click into the cells like that. There's another way to do this really quickly, but it's a little more involved. I'm going to do this like I said, this is kind of the slow way, and you might be thinking, why is this not faster than just clicking between the links like we did for GM, where you click over to that tab. But maybe it's quick. But what I really want to show you is, once you have something like this, and we could even do this for Tesla now, but let's wait. Well, we can wait till after we get the numbers. So now you've got a GM, and now GM's numbers are pasted right here where Ford's numbers should be. But what you can do to quickly adjust this and make this all be the Ford numbers is we can highlight all of these cells that we want to change, because generally all we really want to change here, we just need to change this number, or this word name. This is the name of the tab, General Motors. We can change that name to Ford. And so if we copy that word, General Motors, or you could come down here and double click into the name, Control C to copy it. So then, again, we're going to highlight all these columns. Then we're going to go up to this function called Find and select, drop that down, click replace, and then we're going to say find General Motors. So it's going to find everywhere that it says General Motors. Here it's all the formulas. And we're going to say replace that with Ford. Find that, replace with Ford. And then when we hit replace all, it's going to replace everything that's highlighted. You do need to highlight all the cells, drag that down and highlight those. If you just didn't highlight it and click replace all, it would replace the words there. These words everywhere. We only want it in these cells. So anyway, we'll do that. Hit replace all. It made 10 replacements. And now you can see all at once, we're now pulled in these metrics from the Ford tab now. So it's just a quick way to update tabs, just kind of an Excel trick that I use relatively often if I'm doing something like this where you've got spreadsheets that are basically built the same, but showing individual information. Always a good idea to check yourself to make sure that worked though. Let's say return on equity. If we go to Ford, 13.5, we said 13.46. It's just carried out one more space. 1.16 for the current ratio, 1.16, 5.36. That's good. Kind of a good way to do this though is also to look at the bottom one, 7.92. Yep, that worked. 3.19. That worked. So yeah, kind of cool. Just a quick way to pull in, to change your formulas all at once in multiple cells to pull from different tabs without the other way we do this is we could have just gone, okay, Ford, that, this, there, right? And that's fine. That's, especially in this instance, there's not too many, and it wouldn't take too long to do that. But as I mentioned, you could do this in a whole spreadsheet if you had a whole bunch of cells. So just a trick I wanted to kind of show you there. Okay, let's go back to the color analysis now for Ford. So I think I'm going to go yellow here. We're approaching the bottom of the benchmark range. So again, yellow. This one we're quite under the the benchmark range. So we're going to do red for Ford there in terms of operating margin. Return on assets, we're kind of right there at the bottom of the range again. Yellow. Return on equity. Now this one is quite high, 13.46. Or I guess it's I don't know if I say quite high, but well within the benchmark range. Current ratio, we're right there again, relatively close to the bottom, or actually we're under the bottom, I guess I should say. And so slightly unfavorable, we'll say on that one. Debt to equity 5.36. We are looking not great there. This is what I want to highlight too, to keep in mind when you're doing these kind of analyses. It's not always that less is more or high is good, low is bad, right? In debt to equity, this is basically saying you want a lower ratio. The benchmark is 2.0 to 5.0, but you'd be happy with a 1 versus unhappy with a 10, right? Because that's saying that our equity is 10 times our ratio, our debt is 10 times the amount of our equity. So something to keep in mind. And let's see down here, interest coverage. We are looking quite good there. Inventory turnover, also looking quite good there, right in the middle of the range. Accounts receivable, 12.2. That's right towards the bottom of the range, so I'm going to give that a yellow. And then again, this one, so we're under the range, and I'm gonna put in here just like we did for GM expectations, low growth expectations. So basically, analysts or the stock market, the market conditions based on the stock price indicate that the analysts or the stock market believes the way that this is priced on the market that maybe they expect low growth from Ford, more normal growth from GM. Okay, let's go ahead and do Tesla now, and then we'll kind of start wrapping things up here. So I will click over to my Tesla financial statements, and we'll just do this process one more time. All right, net income is 7153. Again, be careful when you're pulling the numbers off the income statement because they do go the opposite way compared to Ford. So net sales 97. Net sales and revenues. Let's see. Where am I getting that number from? Tesla's. Oh, again, I just want to make sure I'm pulling this in right. Yep, total revenues. So total revenues is the line we're pulling from there, 97690. One important thing to keep in mind as well is that when you're pulling all these numbers in, if you're ever really doing something like this in practice, make sure that they're using the same, delineation of decimals. So these are all in billions, or I guess I'd say in millions. So make sure that one company's not in millions when you have these numbers, and then other companies in thousands or something. Then you would be completely comparing apples and oranges. In other words, if this was 7 billion, that number meant 7 billion for Tesla, but it meant 7 million for another company you're looking at, that would not be an equivalent analysis. So be careful how they list numbers out because they truncate them. Okay, excuse me. Let's see, income from operations, 7076, net sales and revenue. Net income, lots of linking we can do here. Total assets is 122,070. Return on equity, again, linking. Oh, we got to do average share stockholders equity, 72,913 and 62,634. Add 2, divide by 2, add them both, I should say, divide by 2. Okay, 10.6, that's good. Let's go to our current ratio. Total current assets, 58,360. Current liabilities is 28821. 2.02. Debt to equity, so total liabilities now, not just current, 48,390. Total stockholders equity is 72,913. Interest coverage ratio. Again, we're gonna have to. Yep. Let me delete that out. We're gonna need to calculate this number out, just like we have. So income before income taxes on the income statement is 8990. Interest expense is 350. So remember, add those together. So we're adding these back. So 9340 is earnings before income, taxes, and interest. Interest expense, we can just link. Do our division. Make sure I've got that in right. Yep, 26.69. Looks good. Inventory turnover. Let's do our average inventory here. Let's go back to our balance sheet. So we've got 12,017. Current year, 13,626. Prior year. Wait, what did I do there? That's not right. Not divided by 21. Careful with that. Kind of do it reasonable. Just check when you're doing this. Don't go too fast because that, if you're 12 and 13 and your average comes out to 1, you're doing something wrong. So let's go ahead and link that number though. Average inventory, cost of goods sold, back to our income statement. Where am I? Okay, cost of goods sold. $80,000. Sorry, I couldn't find it there for a minute. $80,240, and that is listed as total cost of revenues on the income statement there for Tesla. 6.26. Okay. Let's do our average AR real quick. Just knock that out. and it was 44.18 and 35.08 for prior year. Add both, divide by 2. Net sales and revenue. There we go. And then average AR, we're going to pull that in. 24.65. That looks nice and high. A lot of not having any collections issues. You can tell there 25 times of turning over your whole AR means your collections are happening very rapidly. Price to earnings ratio, again, we'll link to our stock price. Tesla has a really wild stock price because it's one of these, it's almost more of a growth stock if you want, like as in terms of how you would actually classify that, as opposed to more of a legacy auto manufacturing type of stock. So it's almost a little bit of apples and oranges to compare stock price between these three companies, because Tesla is seen more as kind of like a tech company, a fast growth company, whereas General Motors and Ford are seen more as just long-term legacy automakers. So kind of interesting, but we'll do that comparison. But things like that you might want to keep in mind when you are doing your comparison, because again, we want to try and prevent as much apples to oranges issues, make them as comparable, and when they're not exactly comparable, maybe make a note of that somewhere. So we'll look at that on the summary tab. Okay, but earnings per share, let's go back to our income statement. Again, we're using the diluted number 2.04, 178.21. So you can see it's way above the benchmark. And again, like I put it in a note here, it's a growth stock, not auto industry necessarily. This is a growth stock benchmark too, I should say. So if you look at the benchmarks here, 8 to 15 for a PE ratio. For Tesla, for a growth stock, tech stock, you're looking at more what you'd expect to see, 30 to 100. So even though this is an auto company, Tesla, they're a little bit different, unique, electric vehicles, technologies. And so here I've used a little different benchmark just to see how that compares to actual growth stock. So again, way above the growth stock. So Tesla is one of the most the stocks with the highest expected growth rate. I think that would be a fair thing to say there. Okay, let's come back. Let's do our little trick again, just to practice. Well, gosh, don't mess up your formula when you're doing it. So highlight so again, how you do that, click into the cell, then click into the formula button, highlight the formula, Control C, enter, get out of that's how you move out of it. And then click into the Tesla one, go to your formula bar, Control V, which is paste. So we're copying this, Control C, copy paste. So I'm just going to do this real quick for all of these. Or, another way to, as I'm kind of doing here, you can double click and then copy that. Oh, but if you don't click enter after you copy, Control C, messes that up a little bit. So again, there's some other workarounds that I'm not going to go into detail on in this video on, but to do this even faster. But I think it's kind of a little unique type of Excel skill that I wanted to show you all. So again, we should see comparable things here, So if you go to the Ford, inventory turnover, C49, 10.35, we want to change these all to be the Tesla one. And the reason why this works so easily is because it's the same C49 for inventory turnover. C49 should be the inventory. So they're all in the same location. So our formula is then all we need to do is again replace, and I'm going to copy Ford, just paste that in, Ford with Tesla. And this is being driven, these words here are tied into the names of the tabs. So that's what allows us to change all those at once. So 10 replacements. Now let's just check ourselves to be sure we didn't screw something up. 178.21, that's good. Check the first one. Kind of check the first, the last, and then the middle is a good way to make sure your formulas all came through. Yep, that looks good. Return on equity, 10.6. We carry that out, 10.55, 10.55. Yep, looking good. always a good idea to sanity check your work to make sure you're not messing something up as you go. Especially when we're doing a lot of Excel work like this, there's the potential for making a typo or a mistake, etc. So profit margin ratio, we're at 7.32. So I would say that's quite good. We're right towards the top of the benchmark there. Oh, maybe, I mean, you probably saw what I was doing here. Maybe I should just mention this though. So this is the formatting, of a cell fill. They call it the fill in, the fill color. This is the color of the text within the cell. This is the actual filling of the color. No fill is typically how we have it, and it just is blank. So anyway, it's kind of just, it's nice to have these color codes. They just sort of you draw your eye to places of interest, comparison, so on and so forth. Okay, 7.24, again, solidly within the benchmark, so we're looking good there. 5.86, return on assets, that's above our benchmark there, so that's good. And again, these are metrics that higher is better. Return on equity, 10.55, we're a little close to the bottom of the benchmark range there. Current ratio, we've got a yellow. And I have these, I said C note, so current ratio. Oh, this is an interesting one. I wanted to kind of highlight for you all too. So the benchmark is 1.2 to 1.7 for the current ratio. And remember that the current ratio is a comparison of our current assets to our current liabilities. And a lot of the current assets usually is cash that the company has on hand. And so while it is generally good to be higher than the benchmark on the current ratio, to have enough cash on hand to be able to pay your current liabilities, because that's of the most importance, to make sure you can pay your bills. If you start seeing the ratio go above the benchmark and too high, so where did I say that down here? Current ratio, Tesla current ratio, no. As I mentioned here, too much liquidity, in other words, having too much cash on hand, might mean inefficient use of assets, thus marked yellow. Higher isn't always necessarily better for current ratio. So as an example, if Tesla as a company is sitting on a lot of cash, they have a lot of cash buildup, that cash could potentially be invested into some, in some way, as management deems fit. A lot of times, companies would invest in safe, treasury kind of governmental financing instruments, lending money to the government essentially, to be able to earn a return, but with no real risk. Or it could use those assets to buy more machinery or to expand or to innovate, etc. So anyway, I just wanted to make that note that while it is generally good to have a solid current ratio, if it gets too high, and maybe that's where we're at, you'd have to do some more analysis to figure out really what the deal is here. But it's just an area of potential concern that you might look at and say, hey, we have so much cash on hand, why are we sitting on all this cash, and are we investing it properly? Could we invest it? Could we use that money for other productive enterprises, expansions, employee bonuses? I don't know, something to help your employees out, something to make this company stronger. So just something to keep in mind. I wanted to highlight. So debt to equity ratio, and again, maybe highlighting that because again, it's sort of an art more than a science in a way, because it's not like we can always just say, yes, higher is always better. Maybe higher is better, but this is where the human aspect of further research, analysis, understanding of the company's position, where are they at, where are they going, so on and so forth, is necessary to fully understand. We're just doing kind of a quick and fast analysis of these things as a starting point of comparison. And then if you were really doing this as a job, maybe further analysis on these companies, etc. Okay, so with that said, let's keep going. Debt to equity, green, quite low debt there. That's generally, again, maybe you'd say, oh, why is the debt so low? Maybe there's some argument about why that would be bad, but typically having not a lot of debt is very positive in terms of, and a lot of equity. Interest coverage, it's hard to make a case, I suppose, where having more debt would be positive, unless there's some significantly beneficial expansion happening or something where you could make a strong case that more debt is where the company needs to be right now. Kind of like with cash on current ratio, more cash is not the best thing, because you could invest this money safely and make a return potentially. That's more of a likely scenario, at least in my opinion or my perspective. But I don't know, I could be missing something. But low, we're going to call that good. Interest coverage very high, right? We're way over there, so that ties in with low debt. So we don't have too much debt. We have way enough money to pay our interest on our debt, and so that's good. Again, maybe you could make a case for why that's not ideal. We need more debt for some reason, like I said, expansion or innovation, development, so on and so forth. But I don't know. My take on it is this is good, low debt. Inventory turnover, what do we got? 6.26, and I had a little note here as well. So Tesla inventory turnover. This is kind of an interesting one. 6.26. It's got a lower inventory turnover, and I noted here just that Tesla has a different business model with direct sales to customers, no dealerships, compared to how GM and Ford operate with the dealership model. And so I think Tesla does have, I don't know if you can call them dealerships, but you buy the Teslas online like you would any other online product, and then they are shipped there. It's not like a GM and Ford where you go onto a normal traditional dealership and have a salesperson come to you. You do all the purchases for Tesla online, and so that does affect their inventory turnover a bit, in that they can maybe have a lower inventory turnover, but they're specifically making more earnings on it. So on and so forth. So sometimes, again, this is more of just trying to make a point that understanding the companies and how these comparisons, because these might be applicable for comparison, but it doesn't mean you just turn your brain off and go, yep, this is good, this is bad. You do have to understand a little deeper, and this is just kind of a tool that we use to better do that type of analysis. But still, our human understanding is important and all that. Don't turn your brain off. Okay, the more you can use this to stimulate your brain and do research and better understanding, that's the whole point. This is all just kind of a tool to do analysis. Accounts receivable turnover. We are very high there. Again, hard to make a case where that would not be good, because if we have a high, really high, means that we're collecting all of our outstanding amounts owed to us. Again, it is very high. So whenever you see something way outside of the benchmark range, you probably want to think about that a little deeper. And maybe there's a case to be made why this is too high, possibly, but I can't really think of one right now. And in essence, what we're saying is Tesla is doing a better job in collecting payments for its cars. And has less outstanding accounts receivable than either GM or Ford. And having more cash on hand means that you can invest that cash or put it towards use. Again, that's maybe why the current ratio is high, because we're collecting at Tesla so well. But then the question becomes, are we just sitting on that cash? Should we be using that money to, again, invest in the company, invest in outside investments? I don't know. So you need to know the company's mission, their perspective. So, and then finally, this one, again, we talked about quite a bit. Very high growth expectations. Tesla is seen as one of the primary cutting edge tech, auto companies, but they're diversifying even more, I think, into tech products in general. So kind of, again, apples to oranges here in terms of the PE ratio, but still something to kind of keep in mind while we're doing this comparison. So we just put high growth expectations, or you might even put extremely high growth expectations, but we'll just leave it at that. All right, so that brings us to the end of our project here. We've got the, a final deliverable, if you will. We call a deliverable is a report that you prepare, to turn in, whether this is to your teacher or in school or to a boss, for example. And this is very realistic. When I was a CFO, to the types of analyses that we would do, we would find specific key performance indicators that the management and the board of directors wanted to all keep an eye on. And then we would prepare these on an ongoing basis, monthly basis typically, and then present that to the full board of directors and the management team so that we could all kind of have an eye on where the company was. And we kind of focused, we had benchmarks we looked at as well compared to our industry. We also looked at multiple years, or more so like multiple months on a monthly basis. We could look at multiple years as well, just to see how our metrics kind of trend. So if you wanted, we're not going to do it in this project, but a very reasonable extension of this type of analysis would be then to do these same calculations for GM or Ford or Tesla, but have the years, so 2022, 23, 24, 25, 26, so you could see how these key performance indicators have changed over time. So that might be a worthwhile thing. But big picture, this is, kind of a report that you could have, a deliverable that you could present, and right off, you can just look at this and then see where the colors are indicating. Ford is showing up with some reds here. They're the only one in the red, and so that indicates some potential concern. Tesla's pretty heavily more in the green, so that carries some information with it. GM maybe more stable. Maybe this is even reflected in the market expectations here. Low growth expectations. We're seeing some reds. Maybe this is GM's more stable. Ford's a little more in the red here, potentially a little more of a concern. And then Tesla, at least with high growth expectations. But again, this is just a starting point for understanding, and you might need to understand concepts that fall outside of the strictly financial, such as what does the regulatory environment look like? Is there something that's going to happen in the future or in the near or the medium term future that might impact Tesla's business model? Or maybe Ford or GM have some projects in the works with other countries, et cetera, that might expand their footprint globally, maybe something like that. So all this type of information that I'm mentioning right now too is something that you at least can get a feeling for if you were to read the full set of financial statement and the full annual report. And so again, I mentioned at the beginning of this project video, those are usually over 100 pages, between 100 and 200 pages. So if you really wanted to understand the full picture of what the company, how it's operating, what its business plan is, what it expects the future to look like, which would be a worthwhile and necessary undertaking. But you would do that work, and then you would kind of contrast that with these types of analyses as well to further develop your understanding of these companies and where they stand and where they might be heading in the future. So if you were an outside investor, you could make a good investment decision. If you worked for a company that does investing, that might be something that you kind of work through. But yeah, that brings us to the end. Hopefully you found this interesting and beneficial. One thing, we practiced some Excel formulas, so I hope maybe you learned some new things with the Excel. And one takeaway I hope you could sort of see with this, I'm not saying I'm the greatest in Excel necessarily in the world, but maybe this is an example that you can pull away of how to do kind of clean Excel work and put things in standardized templates like this, so that your work looks clean. It's easy to go back and analyze and see where things came from. You can do those copy and replace type of changes, to more quickly update formulas, because you have a very standardized set of analysis templates like these. You can do snippets, but then take that snipped information and actually type it into Excel so that you can link to those numbers. Like I couldn't link to a picture, right? But if you take that number, just take the picture, type it in, then you can link to that number. So part of my goal for this project anyway for you all is to hopefully see some new things about how Excel could be used. And maybe when you're out there in the working world, you might see some opportunity to create things like this for businesses that you might be looking at. Again, it might not be a public company that has stock information and you're comparing to other big companies per se, but every company has key performance indicators that it wants that would benefit from looking at, and as a process of managing the overall financial position and making sure that the company's progressing in the way it wants to. And if you see red on your analysis template, that's a good step to stop and say, whoa, what's going on? And you, as the analyst person, the bookkeeper, the accountant, the controller, whatever senior accountant type position it is, you might become a really valuable asset to the company when they realize that you have your finger on the pulse of where the financial situation is, how it's trending. And hopefully then, you can work yourself and with the team, your whole working team, to come up with strategies if you do see, red on your analysis, and maybe start making business plans and implementing those. That's the kind of activity that drives you towards being a real leader of a company, whether that's from controller perspective, senior accountant, or up to like a chief financial officer. So, alrighty, well, I'll cut it off there. I've been talking a lot, but I think this is a valuable project that has some interesting perspectives just to glean aside from the pure calculation of the metrics. Hopefully you found that as well. So thanks everybody for following along, and I hope you all are having a great day, and I'll